makers and market movers. This is The Pulse with Francine Lacqua.
A very good morning and welcome to The Pulse. I'm Manish Krenny in Dubai. Here's what's coming up on today's program. The Bank of Japan surprises global markets as it adjusts its yield curve control program. The yen whipsaws and yields jump. France's inflation eases even as Spain's unexpectedly accelerates. This after Christine Lagarde says the ECB is open-minded on another hike in September. Plus, in the bag, Hermes bucks the luxury trend with soaring US sales outperforming its rivals, LVMH and Richemont. The shares jump. A very good morning. Oh, to have a Birkin bag in your cupboard. That's the complete inflation hedge. More on that in just a moment. To the European map, we're grappling with an implosion in rates, an implosion in prices, I should say, and a spike in rates. This is the map around the world. We've also got a heap of inflation data to come through. I should just tell you that Germany's second quarter GDP, it's a flash reading. It's unchanged from the estimate of plus 0.1%. But we are getting inflation prints coming through. You had North Rhine-Westphalia earlier. So what have we got? In Hesse, I can tell you it's pretty much on the money. Month on month, just a slightly higher, plus 0.3%. In Bavaria, it's actually higher, plus 0.4% on the month, and year on year comes in at 6.1%. So you are just seeing a mixed bag on the inflation, but for the moment, no dramatic drop into a deeper recession in Germany. As I say, Hesse consumer prices rose by plus 0.3%. We will get to that in just a moment. So as I say to you, you have a number of things to grapple with this morning, not least the fact that you've got German two-year yields imploding again. Rising again. You are just seeing a whole new narrative coming in here across the bond markets. You've got Japanese government bonds really in a volatile spin, the most volatile we've seen on the JGBs since 2008. And this isn't the fundamental reason why. This is Martin Malone at Aurelie. He said yield curve control, the JGB peg is effectively gone. The Bank of Japan is just playing with the market. The radical bit are the inflation dynamics. Now, this is the bond markets for you, the very first reaction. This is the largest change since Kuroda kicked off his easing in April 2013. The July 2023 reversal is because of Japan's booming and inflation dynamics. They are rampant. Now, with that re-rating goes the biggest question you must ask yourself overall. Is the carry trade under pressure now as you see the potential? This is the dollar up now at this stage. We've had a hugely volatile session. Of course, the euro yen was pretty resplendent yesterday. You saw a dramatic move, one of the biggest moves since March. Sterling yen, again, coming back to flat, and the dollar up this morning, as you can see. So it has been a hugely violent set of swings. German bond markets are where you want to pin your focus. As Donaris talks to the market and says he hopes it's the last rate hike that we've seen from the ECB, you are just seeing the impact of this move from the Bank of Japan. It wasn't supposed to be this way. They weren't supposed to blow the doors off. They were only supposed to perhaps do something a little bit more tempered. But with that in mind, the market story today is the Bank of Japan. So let's bring in our Bloomberg Intelligence FX and rates analyst. It is Stephen Chu. So various people have IB'd me this morning. They've said that this is something quite radical. It's not just a tweak. This is effectively launching a new paradigm in rates in Japan. It may be baby steps, but it's coming.
It's actually a very important step. I mean, of course, they deny it's not a normalization for the yield curve control, but to me, it certainly is. I mean, essentially what we're seeing, it's the upper cap has been moved from 0.5% to 1%. That's where the BOJ steps in. It's no longer at 0.5%. So, I mean, that's really the key takeaway, like whatever they say and however they deny that it's a normalization today. Now, it's quite interesting that they said they're going to keep the 10-year anchor at 0%. And the band also 0.5%, around 0%. So that's unchanged. They want to inject a dovish spin in that regard. But the fact is that now the BOJ will no longer intervene, or they're not committed to intervene at that 0.5% level. It's really the 1% that matters. So at the end of the day, it's really a shift in the yield curve control. So I think we are getting closer to the exit. Now, I don't know whether it's going to be in the second half of the year or early next year, but it's certainly closer, because otherwise it will be even more complicated to convey the message, because right now we have like 0%, 0.5% band, and also that 1% real cap that BOJ is watching. So what next? I mean, like eventually, I think the ultimate goal is to take everything away and remove away from yield curve control. That's a matter of time.
It is, and various people have sent me IBs this morning saying, look, if you look at the inflation dynamics, it's behaving like the 1970s in the oil crisis and the 80s boom. What does it say about the future policy direction for the Bank of Japan? They want to play up this dovish tilt that they'll come in and buy bonds at 1%. But that's quite an extreme move. If you look at JGBs this morning, 0.56, so we're nowhere near that limit that the BOJ has set. I just wonder why we haven't immediately tested that.
I mean, like the fact that market may know the BOJ is in the market, so that's why they're not pushing yield all the way from 0.5% to 1%. But it's just really a matter of time. Because if you remember, we start off yield curve control at 0%, and then we moved to 0.1 a quarter, and then to 0.5% last December. I mean, eventually, as long as fundamentals plays along, inflation remains sticky in Japan, yield will have to head to 1%. I mean, even Bank of Japan gives you that level. Like people may be expecting 0.75% today, but then they get like 1%. So that's why it's a doable target. And if you look at the data, it certainly supports inflation to remain sticky as well. Because say the core inflation, which is the CPI excluding fresh food and energy, which is what matters to the Bank of Japan, has remained stubborn at 4.2% in June. And it's like more than double the BOJ inflation target. So if that's not coming down, then certainly the yield will have to reflect that development. And the 10-year yield will have to drift towards 1%. So again, it's a matter of time. And it's a matter of time for Bank of Japan to really want to move away from yield curve control.
Stephen, thank you very much. Very eloquently put together. Stephen Chu, our Bloomberg Intelligence Analytics first take on the Bank of Japan. Our guest first take is from Christian Kopf, Union Investment CIO for fixed income and FX. So we saw this headline this morning when I was here at the office at 5 a.m. and just after that, I should say. But here's the issue, isn't it? It's super core inflation. This is reminiscent of the 1980s inflation. Do you think people out there really quite understand how virulent inflation is in Japan? This is what's bounced them, isn't it?
Well, I do think so. I mean, if we read the communication that we got from the Bank of Japan today, they made it clear that there is an upward drift in wages. There is a change in the price setting mechanism in the economy, in the market prices that companies demand. So there is a broad recognition that inflation is rising in Japan, and especially core inflation in the Tokyo area, which was released this morning, has risen again to the surprise of many. That said, if we look at the long-term inflation projections of the Bank of Japan, for 2025, they're below 2%. No? So much of that rise that we're seeing here is still related to the effects of higher energy prices that we've seen in the past. Some of it should fade. So we do see a sustained increase in inflation in Japan. We're likely not going back to the levels we've seen prior to the pandemic, but we don't see hyperinflation. We don't see 3-4% inflation here forever in Japan.
Okay, I suppose that is what makes a market. We really are trying to grapple with what happens with the yen. In the very first instance, the yen eased. Then we had this miniature rally. We're back in the easing mode again here. I stood back and I said, look, there's two things that I need to understand if I'm looking at risk today. Is this the beginning of the end of the carry trade? And is that what I need to focus on in the FX world? In other words, that filling up my swag bag with borrowing in yen and buying everything else in the world. Not everything else, but those higher yielders.
Okay, Manos, thank you very much for that question. Let me give you some investment advice here, yeah? And let's start with this question, is this the beginning of the end of the carry trade? That has a lot to do with what is happening to Japanese yields, no? So Governor Ueda gave a press conference this morning, and he said he does not expect yields to rise, 10-year yields to rise to 1%. So actually, he doesn't agree with the take that we've just heard from your Bloomberg Intelligence expert. He does not see yields rise to 1%. Why does he not see yields rise to 1%? I think the answer to that is twofold. First of all, today's move was very well telegraphed. Maybe not to the international audience, but I had a chance to speak to very senior Japanese risk takers 2 months ago, and they were all getting informal advice from the Bank of Japan that something is coming up. So I don't think this was much of a surprise to people in Japan. Second, if you look at the level of yields that you have today in Japan, 0.56% on the 10-year Japanese government bonds. That is much more than a Japanese investor would get by buying treasuries or by buying German bonds on a currency hedge basis. Yeah, it's actually more than 100 basis points more than what you could get from buying other bonds on a currency hedge basis. So for a Japanese institutional investor that looks for a safe asset, JGBs are still the asset of choice. It is the highest yielding asset out there for them. And this is why I personally don't expect 10-year yields in Japan to rise to 1% anytime soon. Yeah, and I don't expect the end of the carry trade.
Okay, that's interesting. I mean, just very briefly before we square off on this, we're going to come back to you then. So you don't think we're going to see significant repatriation flows from Aussie rates, British rates, US rates? That's not on the cards.
Nope. That's not what we expect. I think, if people were to do, well, there may be some small repatriation, but that has already happened. No, I mean, if you look at the yields that investors in Japan are facing, they earn much more on the domestic assets than on the foreign assets. That hasn't changed much. So there may be some slight repatriation flow, but not much really.
Okay, let's see where it goes to. The day they test the 1% yield will be interesting. Christian Kopf, my guest this morning on Union Investments, from Union Investments, first take on the yield curve control narrative. We're going to talk about the ECB president, Christine Lagarde. Her downbeat assessment of the euro area economy, that is next on Bloomberg. The ECB hiked by 25 basis points yesterday, pretty much as expected. The president there, Christine Lagarde, left the path open as to what comes next. Let's get to Maria Tadeo. She's on the ground. Maria, you spent the day there yesterday listening in that room to Christine Lagarde. She, if anything, finessed the concept of perfect optionality. She has an open mind. What did you walk out of the room? What did you walk out of the room within your mind?
Look, she has an open mind, and maybe you and I also need an open mind, and that's how life goes. But look, it is a significant change in tone from the central bank, Manis. In the space of a month, they've gone from no, we've not even debated the idea of a pause, to now actually we may get one in September. Remember, she said keep an open mind, look at the data. In September, we may get a hike or we may just hold. The other factor here, which equally important, I would say, is that she also stressed no matter what happens in September, and again, that is a close call, it may not point to a sequence. If they hike, it doesn't mean that they will continue after that. If they hold, it doesn't mean that it will stay like that. It may not be a sequence. It may vary from meeting to meeting. Now, again, when you look at the data, we've had a lot of data today from France, Germany. It's kind of all over the place, as it usually is with the euro area economy. But either way, Manis, it doesn't really matter, because we know they will focus on every data point that we'll get throughout the summer, but in particular, their projections to come in September for that open-minded decision that we're expecting.
Okay, Maria, thank you very much. Maria Tadeo there, who walked out enlightened from the ECB yesterday. We'll return to Christian Kopf, my guest from Union Investment CIO for fixed income and FX. The short end of the curve is imploding. It tanked yesterday on the view that we could be near the end, despite Madame Lagarde's openness. Open-mindedness. This morning we collapse even further as Yanis Stonaris says the next rate hike should be the last. We are very close to the end. Do you think we're near the end from the ECB? Do you think we skip into pause in the autumn? Excuse the dreadful pun.
Yes, I think we're definitely near the end. I think until yesterday's meeting, the ECB was basically on autopilot with their rate hikes, and they were on a mission to restore credibility, which had been lost by underestimating the strength of the inflationary spike that we've seen in 2022. And the message that we got from Lagarde yesterday was much more nuanced. There are still inflationary pressures in the pipeline. The ECB has become very data dependent. And the message we got from other members of the Governing Council as well was, look, I mean, we've got data now. We've got two important inflation numbers coming up. We've had the Senior Loan Officer survey, which shows a weakening supply and weakening demand of credit. We've got the PMIs, which are very weak in the euro area, especially in Germany. So it really depends on the data. I think it's a very close call, as Maria has said. And we actually do expect another rate hike in September, taking the overnight deposit rate to 4%. But it's a close call. You know, there could also be little tweaks that they do. For example, what they could do is they could hike the deposit rate, but keep the main refinancing rate unchanged.
You would say that that is the hawkish surprise. Now, I made a little bit of an error a little bit earlier. The German data, of course, we exited recession, but GDP has essentially stagnated in the last quarter. You know, when you look at the German banking data, the IFO down for the third month in a row, the question then becomes around Europe, not just in Germany, but around Europe, as being to hike further would be policy error.
Well, the ECB doesn't have a dual mandate, it has a single mandate, and the mandate is price stability. And the numbers we're getting here on the inflation front are not that great. I mean, in the state of Hessen, where Frankfurt is located, where I live, we had annual inflation numbers today at 6.1%. In Germany's most populous state, North Rhine-Westphalia, we've had inflation numbers about 10 minutes ago at 5.8%. These numbers are not great. No, they're a far cry from the 2% inflation target that the ECB has. Also, if you look at the inflation projections that the ECB has put out, they're still expecting core inflation above 2% in 2025. So we're not out of the woods here when it comes to price stability. And it's true that the economy is slowing down quite hard. I'm not so sure that Germany is really out of the recession. You know, I mean, who knows what will happen in the third quarter. So the economy is definitely weak, yeah. But there's still some upward pressure on the prices. So on balance, I think given the single mandate that the ECB is pursuing, I think they will most likely hike again once more in September to take the overnight rate to 4%.
And since you're the bastion of FX and rates, I'm duty bound to say the short end of the curve is getting demolished. Is that what's dragging the euro lower? And do we go significantly lower? Briefly.
Yes. So the euro has been dragged lower by that movement in rates. And, you know, we've had a long call now for quite some time that the euro is on an appreciation trend. It moved all the way to 110. We're quite happy about that. We thought it was going to move a bit higher. We still think that this divergence in monetary policy between the Fed and the ECB is in play. We think the Fed is over now.
Okay.
They're not going to hike any further. But the ECB may and will probably hike again in September. And if they do, then I think there will be upward pressure again on the euro.
Okay, let's keep an eye on that, Christian. Thank you so much as ever, Christian. Kopf, Union Investments CIO and Fixed Income FX from a garden near you in Germany. Coming up, NatWest may have reported earnings this morning, but all the attention is on the Farage fallout, the resignation of the bank CEO this week. We bring you the very latest twists and turns from NatWest. Conversations that matter, the insights that you need. This is the Pulse. I'm Manish Krani in Dubai. So NatWest is cutting its guidance for net interest margins this year. The UK bank's results today, they're being overshadowed really by the fallout from its ill-fated decision to cut ties with the politician turned pundit Nigel Farage. The controversy has now led to the resignations of both CEOs from the Coutts subsidiary and NatWest Group. The scalps are falling fast. Our reporter Will Shaw is with me. Will, tell me this. What are the takeaways from the results today? Very similar to Barclays, which is the top of the mountain of NIMs.
So Barclays reported pre-tax profits for the second quarter of £1.77 billion. That beat estimates. It was up about 27% from the same period a year ago. They also cut their guidance for net interest margins. So there was good news and bad news for investors. Ultimately, though, nobody is really watching this at the moment. They are interested in what's going on with the Nigel Farage scandal, and that's where all focus was this morning. So the top executives at NatWest came out and appeared in public for the first time since this began. We saw Howard Davis, who's the chairman. He said, we've got the support of our main shareholder, critically that's the UK government, and regulators. He also said that he intends to lead the board through this in order to provide stability. So his job had been looking quite shaky up until now. I spoke to Nigel Farage yesterday. He indicated that he thought Howard Davis would be out of his job by the end of Friday. It looks now that actually his position might be much more secure. We also met Paul Thwaite, the new interim CEO. He said it's an understatement to say that these are not ideal circumstances for somebody to take over. Frankly, they all sounded a lot calmer and a lot more level-headed than I would have done in this situation.
Well, it certainly turned into quite a lot of hubris over the space of 5 days. Let's see where the story goes over the weekend. Well, thank you very much. We'll show on the NatWest fiasco. The stock is up 1.25% this morning as they guide that it could be the top of NIMS. Now, open those cupboards, search those roof spaces. There could be a Birkin bag in them. The maker of the beautiful piece of leather tells us that sales have jumped. Are they immune to the luxury slowdown? We'll discuss. The Bank of Japan surprises global markets as it adjusts its yield curve control program. The yen whipsaws and yields jump. Germany exits recession in the second quarter, but with output stagnant. This as French inflation eases and Spain unexpectedly accelerates. Christine Lagarde says the ECB is open-minded to another hike in September. Plus, in the bag, Hermès bucks the luxury trend with soaring US sales, outperforming its rivals like Louis Vuitton and Richemont. The stock jumps. Very good morning. Welcome to the Pulse. I'm Manus Cranny in Dubai. We got there. It's Friday. Don't worry. She will be back next week and the car will move steadily and gracefully. But for now, I want to take you into something that is not graceful and not moving mellifluously. The bond market is ravaged this morning across the world. Aussie rates spike. You're looking at JGBs at the highest since 2014. US Treasury yields are now pumping higher towards an 8-month high. The JGBs have spiked by 13 basis points. That has invoked a wrath of the bond trader in Australia, in Germany, and in France, those OATs. And never forget the gilt, boys and girls. They will not be left behind. So you're seeing this propulsion and re-rating in the bonds, 3 standard deviation move in the JGBs. I can tell you that in terms of the movers this morning on the top markets. So we are grappling with what it is that the Bank of Japan has done. There's a wonderful movie. It's called The Italian Job. And in it, Michael Caine said, I only told you to blow the ... doors off, and you must decide whether the Bank of Japan has quite imploded the mini and the doors, or really just taken a mini move. I'll leave you with that thought because it is important. It's got repatriation issues. It's got yen issues in terms of will the yen continue to strengthen? When will the traders test the 1%? On the JGBs, you're looking at the belly of the curve there. There's your 10-year yield at the moment, 56 basis points. We have exploded higher by just under 12 basis points. At one stage, we popped higher by 14 basis points. Those are the issues in bond markets. They have significant ramifications for the flow of global money. Let's talk about perhaps where there's some resilience. Hermès, what a wonderful shop to go into. You've got to have a hell of a budget to get in there. There is the bag, the Birkin bag in its many forms. Sales jumped. The Birkin bag maker reported strong demand in the US. That contrasts with the luxury rivals LVMH, who have suffered sluggish growth in the same region. Joining me now to discuss is Aurelie Husson-Dumoutier, HSBC's Director of Equity Research at Luxury Goods. Good to have you with me this morning, Aurelie. I look at Hermès. They have soaring demand in the US. Is Hermes a brand in luxury that can live with impunity when you look at everybody else?
Well, thank you, Manus, for having me. Well, you know that the luxury sector is, in the end, a cyclical sector. But that is to say, maybe with the exception of Hermes, because this is the most resilient business model in the sector, also because of the backlog of demand that they have that help them smooth the different macro headwinds in different regions. That is, you see that the Hermes stock is up 2% today. The market's clearly welcoming the beat in Q2 expectations. As you said, Hermes is the only one in the sector that has not suffered a slowdown in the US, also because probably they are less exposed to the aspirational clientele that is clearly suffering from this macro headwinds. And also the beat in EBIT margin that has reached a record high level of 44%. And also, we can also mention that the CEO said that July trends were not suffering any slowdown. So definitely, this is very good news that we hear from Hermes, and much better than the rest of the sector.
Which takes me then to the quote from LVMH, the CFO. Of course, we saw them see some cracks in the walls in the United States. But this is what the CFO had to say. The global mood isn't for the revenge buying that we experienced in 2021. So we're talking about a normalization. And I think that this is, this is where we are. Would you agree that perhaps that revenge buying splurge that we had in Europe and the US is past?
Well, probably yes, but you know that you have to bear in mind the comparison base. 2022 was a very hectic year with a part of China being closed. And so this is why you can see such high level of growth, especially in Q2. So heading towards Q3 and Q4, the growth in the sector will not be as strong as H1, simply because of the comparison base. When it comes to normalization of the growth, this is something that we are seeing progressively region by region. So the US have started, the local European demand is also started, but even if we say normalization, the level of growth remains double digits. So this is still very, very buoyant.
Who's most threatened by, I don't know that I actually live an aspirational luxury life, but it is all around me here in Dubai Mall, in Fashion Avenue, etc., and Mall of the Emirates. I'm clobbered by luxury every turn of the corner. But apparently there are cracks in the aspirational luxury market. So who's most at risk in that camp? Because that's probably the most worrying thing of all, the aspirational luxury area, is it?
Well, the aspirational, it's the entry price point. So every brand in the sector do have an offer in entry price points, we would say below 500 to 600 euros. But this is true that because of the positioning of some brands such as Hermes, such as Chanel, they are less exposed to this clientele, but all of them have an offer for these aspirational clients.
When it comes to the Chinese tourists, and I think you make this point beautifully, which is they're no longer traveling in that sort of massive pack. You turn around on the Champs-Élysées and there are groups of tour operators with a little flag. So you're saying that we're no longer seeing this from the Chinese and perhaps the Japanese. We're seeing individual travelers, but this does have an impact, let's say, on the tourist dollars for the big brands, doesn't it? How will that play out in your perspective?
What we are seeing right now in Europe is definitely individual Chinese traveling, and I would say probably the richest of the cohort who are traveling to Europe. We expect groups to come back to Europe at some point, but probably not before end of Q4, beginning of 2024. So this is why the big challenge in the sector is to be able to welcome in the store this tours of Chinese customers, and this is why they have to ramp up their investments, especially in personal, in order to welcome them.
Listen, I can't let you go without talking about hard luxury, albeit a sub-segment of it. We keep a Bloomberg monitor on the hard luxury and the second-hand watches. This caught my eye this morning. The Bloomberg Sub-Dial Watch Index fell 1.4% in a month. We're now down 16% on the year. Now, these are the 50 most traded watches that we keep an eye on. I know that it's not going to be the core of hard luxury, but Omega Cartier gain as Rolex keeps falling. I was quite surprised by that. What stands out in hard luxury? I don't know whether it's reached the price point of where I can afford a new watch just yet.
Well, in hard luxury, you have two segments. You have jewelry that is performing very well across the board at Richemont, at LVMH. We've seen very, very good trends, and this is true that the watch market is probably less buoyant than the luxury, within the hard luxury market. When it comes to watches, an interesting comment that we heard from Swatch CEO was that in China specifically, there was kind of a slowdown into the high end because probably some of the Chinese consumer were waiting to travel to purchase these very high ticket items, and they see stronger growth within the entry price points. So we'll see if this happens next year when these tours of Chinese come back to Europe.
What's your take on the Kering reboot? I mean, Gucci went through a sort of a renaissance, a phenomenal renaissance for the Gucci brand. That has worn thin. We have a structural change, a change at the top. Bizarre is to be replaced by Jean-François Palus. Are you convinced by the Kering reboot of Gucci, of the group?
Well, the CEO of Kering, François-Henri Pinault, yesterday has made it very clear that he was expecting Gucci to renew with growth as of September. So this we do not have to wait long to see if that comes out. The change, clearly the topic of the management change was the focus of the call yesterday, more than the results itself. So what he explained is that he wanted to appoint someone who knows the brand inside and out, and maybe bringing out an external candidate to the group would have led to a transition period, an integration period, where during which he would probably not have the new CEO would not have been able to renew his growth as of September. So we'll see. Once again, not too long.
Aurelie, Aurelie, I can't let you go. Sometimes when I used to present with Danny, I wondered what she would buy me as a gift. Right now, what is the hottest thing that you'd like to get to buy in luxury right now? What should we be focused on?
You mean in terms of stocks or in terms of products?
No, in terms of product.
Oh, in terms of product, there are so many beautiful things in so many brands that it's very, very, very difficult to choose.
That is so agnostic, and you just don't want to get in trouble with any CEO. I can tell.
Exactly.
Okay,
exactly.
We'll leave it. Exactly. Okay, you can tell me offline. I'm open to gifts.
Aurelie
Husson-Dumoutier, the HSBC Director of Equity Research at Luxury Goods. She doesn't want to upset the CEOs. Coming up, the European satellite operator Eutelsat beats. We've got the questions remain over the merging with OneWeb. Have they paid too much? We'll ask the CEO. She's with me next. It is Eva Berneke. The conversations that matter and the insights that you need. It is The Pulse. I'm Menace Crenny. Eutelsat shares are down a touch this morning, despite the satellite operator reporting EBITDA for the full year that beat on the estimates. Now, this comes after the company was downgraded by Fitch following the planned merger with the British provider OneWeb. Joining me now is the CEO, Eva Berneke. She joins me now on the back of these numbers. Thank you so much for being with us. I mean, on the business, let's just square that away. Once you've done this deal with OneWeb, how much market share do you say you will win over the next couple of years?
Within connectivity, which is probably the market you're talking about, we will be one of only 2 players who have a constellation in what you call low Earth orbit or LEO orbit. So the low Earth orbit constellation, the other one being Starlink. So what we are buying with OneWeb is a quite unique asset. It's one of only 2 operational LEO networks in the world. And they are not going to be more, we estimate probably max a handful of LEO constellations in the world. So to us, it's quite unique that we buy this asset of a low Earth operational constellation. On top of it, the strategy is that we combine the 2. We combine the best of both worlds with the geostationary satellites which Eutelsat operates today, together with a low Earth orbit constellation, and actually be able to provide a multi-orbit constellation.
What is the growth for that low orbit satellite market? You say that it's going to give you a unique position, but what is the growth of that market?
It's a market that's seeing an amazing dynamic right now with quite rapid growth. Today, we estimate the connectivity via satellite, so connectivity via satellite market to be around 4.3 billion. We expect that to grow to 16 billion, so almost 4 times as much in 2030. Now, a lot of that growth would actually come in, yes, it's quite dynamic. I'll try to explain a little bit why that's happening. It's happening because we are all of a sudden getting access to cost-effective satellite capacity that also responds to latency demands. So a much lower latency, which gives the same user experience as you can actually see on normal terrestrial networks. That's what the low Earth orbit with Starlink and OneWeb actually will be able to provide. But also costs are coming down in terms of terminals, so it's going to be a market which is going to be accessible in many more user cases. What we're seeing right now is especially that mobility segment, whether you're on an airplane or whether you're on a cruise ship or whether you're in shipping, is eating up all the capacity we can actually get to the market. So the connectivity in general via satellite is actually a very dynamic niche in the global connectivity market.
Okay, so those are the pillars of why you're doing the deal and what you're going to get. I've got Fitch. I'm opening the statement in front of me now. They're lowering you've been downgraded, okay? And they're worried that the planned merger is going to lower your revenue visibility amid pressure in key segments. Bloomberg Intelligence says you're overpaying for this deal. So let's square some of this away. Justify the price that you're paying for OneWeb. Are you overpaying?
I don't think so. What we're doing is we're buying a quite unique asset. Being a unique asset also makes it quite difficult to actually value it. What we did was we actually, when we announced the merger of the 2, it was at the very last cost estimate, where OneWeb had taken in new shareholders just 6 months prior to the actual deal. 6 months prior to the deal, that asset was valued at exactly the price we bought it at. On top of it, and I think it's important, is that the OneWeb shareholders are actually joining the new shareholding. They are staying shareholders in the combined entity. So it's not a cash deal, it's actually a full share deal. And then the final couple of points is that OneWeb has probably invested somewhere between 5 and 6 billion in the network, and we're paying much less than half for it. And the final one is the only comparable that I can find out there today for a LEO constellation is Starlink.
Okay.
And that's kind of a totally different mindset in terms of evaluation of well over 100 million. That might not be fully correct for OneWeb, but it certainly doesn't sound like we paid too much.
The other argument, I mean, from both the ratings agency and from Bloomberg Intelligence is that you're diluting your predictable cash flows. The synergies that you're perhaps hoping for are already all in the price. A quick response on that. Are you diluting cash flows, and do you think you're overambitious on synergies?
No, I think synergies are actually quite real. And we've just spent a few months actually trying to work them through and updating them since the deal was announced a year ago. And we feel quite comfortable with both the synergies we have on OPEX, as well as revenues, as well on CapEx. So the synergies I'm quite comfortable with. The downgrade from Fitch was absolutely expected. Eutelsat is fundamentally changing its makeup. We used to be a very predictable, very cash flow rich, very high dividend paying share. High predictability because we were in a market with a lot of visibility, which was the video broadcasting market. And now we're adding a totally new high growth, but also high uncertainty market on top. And it's clear that rating agencies like visibility and predictability, and that's not necessarily something you get in a very high growth, very dynamic market.
Okay, well, we'll draw a line under it there. Those are the defense. That's what you're there to do, to drive the business and to make sense of this deal for the market. Eutelsat CEO Eva Berneke with me this morning. Coming up on the show, the Bank of Japan jolts the global bond markets, yields spike. We bring in the analysis. It was a shocker, or was it just a tweak? Welcome back. The Bank of Japan has jolted financial markets after announcing a tweak to its long-time yield curve control. Our markets reporter, Valerie Teitel, joins me now. So the yen is having a bit of a whippy session. I mean, what is the latest? I mean, we saw a drop in the yen, a little bit of a rally, but we're very unsure.
The market is very unsure, Manus. I, am still confused of myself and how the Bank of Japan exactly is going to implement this flexible yield curve control policy. But the dollar yen has had quite a day. It has the yen has weakened quite maybe slowly since that press conference took place from Governor Ueda just a few hours ago. We're now almost back to a 140 handle at 139.72. But a lot of the confusion about dollar yen, a lot of the whipsaw here was really about the confusion around how the Bank of Japan is really going to implement this. And I want to go over that in my next chart. So they didn't necessarily officially change the band. The band is still at half a basis point right here where this yellow line is. What they did announce is that they're going to have flexibility in when they implement it. So in between 0.5% and 1%, how many bonds will they buy? That's what the market is trying to figure out. And even Governor Ueda said in his press conference, he's not sure himself. So just how much more easing does the Bank of Japan plan to do? Just how much defending of this new range do they depend to do? It's all very good questions that the market is asking right now.
Well, it sent a depth charge across global bond markets. I know the short end of the German curve has tanked. That's Daenerys' comments and sort of idiosyncratic stuff at the short end of the curve there with Lagarde. But the rest of the bond market has been propelled higher. Aussie rates, French rates, Brit rates. So this is a depth charge in global bond markets. Square that for me briefly.
But look, Manus, I need to say that it's a lot. If you look at what's going on in the Treasury market, they really have hardly moved this morning. If you look just at the 10-year Treasury, this is the one-day change. It's essentially flat, right? It's not really telling us that this bout of term premium is about to be released on the global bond market. If anything, they're holding in quite well. I am very surprised to see that Treasuries are rallying on the day.
Okay, well, not such the case with the Aussie rates. Aussie rates up 14 basis points. The belly of the curve in Japan up 5 bips and Sweden up 8 basis points. So we now need to question the carry trade and repatriation. Quick snapshot of risk for the tech sector. This is what we've got. Look at that. Intel up as they deliver good numbers.